Hello my fellow freedom builders and welcome back to the channel. Today it is time for yet another video in the series of Indicator School, where we are touching on a new indicator every single time. Today we're going to talk about the Bollinger Bands invented by John Bollinger for many years ago. The Bollinger Band is a bit of a special indicator, and it is one that I truly love and often have in the background of my charts if I need to check something with the price, if it is about to reverse or if the trend is very strong. What we're going to talk about today is the basics of the Bollinger Bands. We're going to talk a bit about a statistical topic called standard deviations. I know it might sound a bit dry, but it actually isn't, and it is very important to understand how this indicator is built up, because that gives you a lot of tools to profit from it. And I will, in the end today, show you how I profit from it. I'm going to show you a lot of different ways to use this indicator. It is an indicator that most people actually use in the wrong way. So I am going to show you how John Bollinger is describing it himself, how he thinks it should be used. So we're going to talk about two side indicators from the Bollinger, something called the Bollinger Band Width and something called the Bollinger Percent B. We're going to talk about the different strategies, the squeeze, the expansion, trend confirmation, trend breaks, Bollinger W and M's, and the Bollinger indicating combinations. Because even John Bollinger is saying that you should never use just the Bollinger Bands as a standalone. You should always use it in combinations with other things. And just remember, the thing I say every time we make this indicator school videos is that an indicator is never telling you the complete truth. It is just telling you what it indicates. So an indicator indicates something, and you should be able to see it in other ways as well and combine it with other sets of data so you can be even more sure. But let's go to the basics. Before we do, remember to hit the subscribe button, the like button, and all the buttons you can find down there. All right. First of all, we need to look at standard deviations. Now, what is a standard deviation? Well, let's start with the really boring stuff. This is a calculation. And before you skip the video, I'll not ask you to understand all of this completely, but it is important just to get a quick grasp at it. Here we have a data set. That could be price numbers of a stock, 2, 4, 4, 4, 5, 5, 7, 9. All right. Now, if we calculate an average here, I think most of you know how to do that. We add all of the numbers together. We divide it by the number of observations, and this is 8 because we have 8 numbers, and that makes our average 5. All right, so far so good. Now, to get the standard deviation, you make a ton of calculations down here, and I will not ask you to get a grasp on these unless you are very good at math. But what we end up with all these all these calculations of standard deviations is that this data set has, if we calculate one standard deviation, it has a standard deviation of 2. Now, it is important that you understand what that means, because imagine that we have the average here of 5. Then the standard deviation of 2 means that in theory, most of the data, at least 2/3 of the data, should be 5 plus 2 or minus 2, meaning that the data set, at least most of the data, should lie within 3 or 7. That is 5 plus minus 2. So we have 3 down here, we have 7 here. And let's have a look at the data set. Oh yes, most of the data is actually within that range from 3 to 7. And that tells us that one standard deviation here contains about 2/3 of all the data points. Now, why do we need this? Well, let's have a look at something called the bell curve. That is something from the statistical world telling us, we talked about one standard deviation here before, that contains 2/3, or to be precise, 68.2% of our data. If we calculate 2 standard deviations, we go a bit out further and imagine that we have a lot of data points which could be stock prices lying here, and then a few outliers out here. Then we would know that within 2 standard deviations, we would have 95.4% of all our data. Now, enough with the math. I'll show you on a chart what this actually means. Just remember that 2 standard deviation equals in a statistical term, that the price range, that the bands here contains around 95% of all our data. Good. So let's go to a chart. That's why we're here. Here we have the Bollinger Bands. And what you see here is a lot of data. That is the prices. That is our data points. Then we have our line here. That is a moving average. That is our 20-period moving average as we know it from all other trading. But then we have the Bollinger Bands. And the Bollinger Bands here, if we just click into it here, we can see that we have our 20 SMA. And then we have ±2 standard deviations, just as we just talked about. That means that at any given point, let's see here, within these two bands, we will have 95% of our data. Now, why is that important? That is important because the second our data points, meaning our price, starts to penetrate one of the bands, we know that these are outliers. We know that the data, or at least 95% of the data, ought to be within these two bands, the outer limits here. And that means that we can tell a lot about the price movement. We can tell about something about it being strong enough to break out of these bands. We can also maybe tell something about when it is about to return to the mean, meaning that it is reversing. So with all that knowledge, we can actually get some very good odds when we are trading. But this is just the standard. Well, you can see here, right now we have our quite wide band here because the price is very volatile. You can see that at times where the prices are not moving a lot away from the 20 SMA here, we can just have a look at it here. We can see that at times when the price is not very volatile, then the bands are very narrow here. But all of a sudden, the price starts to move very volatilely here. And we can see at the same point that the bands here, they have to expand. Because if they need to contain 95% of the data, and the data is all of a sudden all over the place, then the standard deviation bands need to be very wide. Okay, so what this just tells us is, when is the price movement very calm and not volatile? And when do they become wild and volatile? So let's see what we can actually learn from this and how we can profit from it. As I said, I do have a couple of other side indicators, and I'll just introduce them right away. It is the Bollinger Band width and the Bollinger Band %B. And I put them down here. If you're using TradingView as I do, you just go up in the indicators here, and down here at Bollinger, you find them with the Bollinger Band width and the Bollinger Band %B here. All right, so I'll just put the Bollinger Band width on for a start. What this tells us is simply how wide the Bollinger Bands are from each other. So you can see here that at this point where the Bollinger Band width is at its highest, that is where the difference or the distance between the upper Bollinger Band and the lower Bollinger Band are the farthest here. As soon as they start to come closer together, the Bollinger Band width starts to drop. And this is actually where we can find our first way to use the Bollinger Band. Because as I said, we should look at something called the Bollinger Band squeeze. And a Bollinger Band squeeze is where the volatility of the stock or whatever we are looking at, a forex pair or gold, or a Bollinger Band squeeze is where these two bands are getting in very close to each other, telling us that there's almost no volatility. Now, when we look at almost any data set from stocks or forex or commodities, we can see that the volatility of the instrument varies, meaning that it goes up in volatility and the volatility drops, and it goes up in volatility and the volatility drops, and it goes up in volatility. And every time we see a squeeze like this, it is very likely that the second we get a break out of that squeeze, a violent break out of that squeeze, that is normally a sign that we will see a lot of more price action now, and very often it is in the same direction as we see the breakout. So when we see this squeeze, we are going to look for a breakout to one of the directions. We don't know which direction, but one of the directions, and then we will have a look to see if we can find some confirmation that yes, this is the way the price is going to move. So every time we see these squeezes, we are looking for large movements just right afterwards. Now, this is a squeeze, and this is a very important thing, and there are different other indicators that can be used in combination with this. But you can always see it, and you can actually scan for it in many software packages, scanning for the lowest Bollinger Band width point in, for instance, 20 or 30 or 100 periods here. We can see if we can find another one. Yes, we can see here that here we have a low point. It doesn't give us a violent breakout, so it's not really telling us anything about the direction. We do have a squeeze here where we get a breakout and then some further downwards movement. Now, let me just give you another way to look at the Bollinger Bands that is to be in combination with the squeeze, and that is the expansion, because the expansion is pretty much the exact opposite of what we are looking at when we're looking at a squeeze. And an expansion often comes right after a squeeze. So what an expansion is a move so violent that it forces the two Bollinger Bands in each direction. So the volatility goes up so quickly that the Bollinger Band needs to get very wide to be certain to contain 95% of the data. When we see first a squeeze, now this is not a very typical squeeze, but it is quite low volatility, and then we see an expansion where the price moves up so violently that we see the two Bollinger Bands being forced from each other very, very quickly, then we can be pretty sure that we are looking at a price direction that we should look out for. Sometimes we then look for a little retracement and then a move up, and sometimes it is just a straight line up. We can see one more of them just afterwards here. You can see we are having the squeeze. The Bollinger Bands are getting very close, meaning that there's almost no volatility here. The Bollinger Band width is very low here, the lowest for a long time, and then we get the violent move where the two Bollinger Bands are forced from each other, and what we see here is a longer time period with a pressure downwards. So this is a statistical tool that is very, very useful when we're looking at explosive moves, but there are more to it. As you can see, we have some trend confirmation, we have some trend breaks and pauses, so let's just have a look at that. Now, if we go into the chart again, what I like to use Bollinger Bands for as well is trend confirmation. And when a trend is moving nicely upwards like we see here, we often see something called walk of the upper band, or it could be walk of the lower band, but a walk of the upper band simply means that we go out here and we see the price staying between the 20 SMA and up, touching maybe a bit above, but just up around the upper Bollinger Band. So it's simply walking the upper band here. That tells us that as long as the two Bollinger Bands are pretty much parallel here, we kind of have a trend channel where the price is strong enough to stay in the upper range. Now we can see here, for instance, and I'll show you something where we can see that our trend is actually about to reverse. Because what we can see, let me just find my drawing tools, we can see the price here walking the upper band, and it even does that in a way we don't see that often, but where it's making a squeeze all of a sudden and then exploding upwards again. We are seeing a little expansion here, and it walks the upper band, walks. But all of a sudden, we see a price movement downwards, and we have seen parallel Bollinger Bands for quite a while, but when we start to see the upper Bollinger Band curl down, actually mostly like this, but sometimes you get already, we see it back here, when the upper Bollinger Band starts to curl down in the direction here, it actually tells us that we are about to see a very slow development of the trend or a reversal of the trend. So here it turned down. We can see that, let me just delete some of these arrows here. We can see that we had the expansion as long as with the violet move down. So that tells us we're going down here. We don't know how much. At one point, the upper band starts to curve down so that we get parallel lines. It means that right now our trend is intact. But all of a sudden we are in a downtrend and we get some move up here, and the lower the lower band starts to curve against our trend. That tells us that the trend is probably over. So when you're in a trend, if it is an uptrend and you see the upper Bollinger Band starts to curve against the trend, or you are in a downtrend, as we see just right after here, and you start to see the lower Bollinger Band curve against the downtrend, that tells us now it is about time to get out of the long or the short position. So that is very, very helpful. You can see the squeeze is formed here because the lower band is getting up here, and we can see the breakout. We can see a very small expansion, not very strong, but we can see the upper band going up, this one at least going sideways, and then we start to see the parallel lines forming and the warp of the upper band. So that tells us a lot. Very good. So that is yet another way to look at it. If we go back here, we can see we also have the Bollinger W and the Bollinger M. And these two are actually the thing I use the Bollinger Bands for the most. Because we'll have to have a look at the other indicator down here. I'll just move it up so we can see it on top here. That is the Bollinger Band %B. And what that tells us is where the price closes compared to the Bollinger Band. So imagine that each and every point on the upper and the lower Bollinger Band is being drawn as two parallel lines here. So this is the upper Bollinger Band, this is the lower Bollinger Band. The second that this daily candle closes above the upper Bollinger Band, you can see that we spike up above 1. So 1 is the upper Bollinger Band, 0 is the lower Bollinger Band. You can see here and here and here where we closes below the lower Bollinger Band, we actually get some indications here, down here, that we are below 0. As long as we are above the 20 SMA, but below the upper Bollinger Band, you can see that the price oscillates up here, and all of a sudden the price ends above the Bollinger Band, and that is what we see here, where the %B is going up above 1. Now, how can we use that? Well, it is an extremely effective tool to show us if a trend is about to reverse. Because what we need to see, or at least in a strong trend, we know that the price can shoot up to the upper Bollinger Band and sometimes even outside the Bollinger Band, but you can also see that it doesn't take very long for the price to come in between the lines again. Some people are using that as a reversal sign, saying, well, when we are outside the Bollinger Band, it must mean that the price is about to reverse. But as you can see, just in this case with Adobe here, if you went short here and maybe short here and short here, you would simply be ruined, as well as if you went long here and long here and long here. That would be a very expensive adventure to go out on here. Now, what you can do is that you can see if the price is able to push out to the same distance towards the Bollinger Band. So let me give you an example here. Here is a very good example. In normal technical analysis, we would look at this here and see a higher top and yet another higher top, meaning that we are in an uptrend. Isn't that correct? Yes, it is. Now, when we're looking at the Bollinger Band, we actually see something differently, because here we can see that the price had so much power that it could shoot way outside the Bollinger Band. Then it went down again. And if it were to be just as powerful again in the next move, we would see a price go up here. But what we only saw was the price turning down from here. And when you see the price here compared to the upper Bollinger Band, you can see that here we were up way above the Bollinger Band, but here we couldn't even get up to touch the Bollinger Band. And that is actually what is called the M here, or a skewed M. Because when we see, it is actually kind of like looking at divergence, if you know that from, for instance, the RSI. We can see we have the price movement here, and that is telling us that it is a new higher top. And the normal technical analysis theory tells us that then the trend is strong. But when we are looking at the percent B, it shows us that we are, or the price is not able to shoot quite as far up as it theoretically should, if it should keep above the upper Bollinger Band. So that is a very, very good indication that a turn is about to occur. Let's have a look at some more here. We have a lower bottom. We had yet another lower bottom here, telling us that, of course, this is a good and solid downtrend. And what we can see is that it shoots below here, it shoots below here, it shoots below here. Now, this is not very obvious, but there is actually a little divergence here. Let's see if we can find something that is even better. Let's have a look at this one. What we can see here, the top, a new top, the top, a lower top. That is just that is the one we looked at before. And what we can see here is that we are getting a confirmation of the uptrend as long as the upper tops here keeps getting up at the upper Bollinger Band or above it. Now, right now, Adobe is in a great uptrend, and we could assume that this one could go up even further. But let's say that it goes up, makes a new top, but the Bollinger Band turns here. It simply cannot come up and touch the upper Bollinger Band. Then I would consider taking my Adobe position off, because statistically it shows me that it is not as strong as it used to. Let me give you another example yet. Here I have picked a gold, which is just a commodity instead of a stock, but it really doesn't matter if it is a commodity or stock or a forex pair or whatever it is. But let's see here, we have gold, and this is in February and March. We have gold on a daily chart showing us a fantastic uptrend, and most technical analysts would say higher top, higher top, higher top, higher bottom. Wow, we're in a very nice uptrend. It must go on forever. But the clever technical analyst would say, yes, we do have a higher top here, and we do have a higher top here, but have a look at this. This higher top made it way outside the upper Bollinger Band. This one could not even get up and touch it. And then we saw a day with a lot of drop here, along with a drop here, telling us that it might be time to get out of this. We can also see here we have the squeeze, we have the violent move up, making an expansion, so we could have made some money here. But as soon as we saw this skewed M, or we can also see it on the other way around on the bottom as a W, then it is time for a trend direction shift. So this is actually one of the most efficient ways of spotting potential shifts in trend. It's not in a way that the second I see it, I just take the opposite direction. But let's say for instance we have the gold here, and we do see a spike down here. That goes below the lower Bollinger Bands here. Then we have an even lower bottom here, but we see a little divergence here. That tells me that I might want to go down to a lower time frame to have a look at how it looks there. So here I am on a 4-hour time frame, and what we can see here, and this is just to show you that this can be used on every single time frame, we have the expansion up here in gold showing us that this was probably going to be a bearish move. Then we have a bottom here way outside the lower Bollinger Band. We can also see that on the percent B here. And then we have a similar bottom here. This would normally just be called a double bottom, but look at here. We have the divergence where here we can end outside the lower Bollinger Band. Here we cannot even touch the lower Bollinger Band. We get the squeeze here, and then we get the expansion of the Bollinger Bands, telling us that this is probably gonna be a move that lasts for a while. So these are different ways of using the Bollinger Band. So it's a squeeze, the expansion. We have the trend confirmation and trend breaks showing us in these walking the upper band or the lower band. And we have the Bollinger W and the Bollinger M showing us that what we normally thought would be a higher top or a higher bottom compared to the Bollinger Bands actually sometimes shows us a lot of weakness in this trend. Now what you can do is that you can combine this Bollinger indicator with other indicators. It could, for instance, be in a way, let me just see here and delete this. Now I just put the MACD indicator on here, the MACD that measures the trend strength. So remember what the Bollinger does is that shows us volatility, and what MACD shows us is that we have some violent trend downwards here. So what it shows us here is that we get a squeeze, we get the expansion, we get a confirmation from the MACD telling us, yes, the trend is actually downwards moving. Then we get a shift in trend direction here with the MACD. That should not always be the reason for taking a trend off. It just tells us that the trend is going a bit sideways here. But then we see, in combination with the MACD shifting trend here, we can see that we have the bottom here, we have the bottom here, but they are actually higher bottoms instead of equal bottoms here. Combined with this movement in the MACD tells us we might want to consider taking our short position off, and some aggressive traders would actually take a long position here, and some would wait and say, oh, let me just look at this squeeze for a second. Yes, we got the squeeze there, the two Bollinger Band running away from each other, and a MACD that is very clearly signaling that this is an upwards movement. So we are moving up, we are making money, we are getting a double top, or do we? Look here, we have this divergence where we might have equal tops, but in terms of the Bollinger Band, it shows us a lot of weakness. In combination with the MACD turning downwards, we could consider taking a down trend here, or we could wait to see if we got some very good expansion downwards. So I hope this gives you a picture of how to use the Bollinger Band. I truly hope that you won't fall into the trap of just thinking that since the Bollinger Band is a statistical tool showing us that 95% of all the data should be inside the band, that you just go long every time it's outside here and short every time it is outside here. Some traders use that, but often it is, for instance, with a larger standard deviation. It could be, let's see, say 3 standard deviations, because if the data here can end outside 3 standard deviations, I'm not even sure we're getting a clear signal here, then it is a good sign that it is about time to get in the opposite direction. It can also be used as a reversal. Let's just take it down to 2 standard deviations again here. It can be used as this reversal trade, but then I would recommend that you use it in what is called range bound markets, where you are pretty certain that you are moving in a range, because then it might be possible actually to time your short trades in combination with the former tops here, and then up and touching the upper Bollinger Band here, maybe going long here, taking a long more here, waiting for it getting up to the top of the range, exit the long, taking a short, and so on and so forth. But it is not my favorite way of using it, not at all. I don't think that the Bollinger Band is extremely strong in that way of having a reversal in a range bound market. It can be used, and I know a few traders that use it, but I would recommend that you start by plotting the Bollinger Band on your chart and plotting the %B and maybe the Bollinger Band width on your chart, and then start to look for these false tops where you actually have a double top here, and you're saying that is equal tops, but when looking at the Bollinger Band, it is showing you that it is actually dropping. It can also be if you want to be confirmed in a trend and you're seeing here, for instance, we are seeing some higher bottoms here. You might want to be looking for some sort of breakout of a triangle. Well, if this is rising bottoms here, you could actually see, do I also see rising bottoms here? And if you do, you can take that as a confirmation of a potential breakout after this squeeze. I know it can sound a bit complicated, but it is a very nice visual tool, and it is a tool that I use a lot, especially when I am trading the shorter time frames and when I'm using it on commodities and forex pairs. But I also have it in the background so I can drag it in on my stock charts if I am a bit in doubt about how strong the trend actually is. So try to experiment with it. Ask me any questions, if there are any, in the comment section below on the Facebook page or on email. I try to answer all the questions that you send. If I don't answer, then write again. I probably missed it in the large flow of messages I'm receiving every day. That's all for now. Thank you for your time. Take care of yourself and your money out there. I'll talk to you again soon.